my name is James Smith-Williams. I'm from Tulsa, Oklahoma, and I am a finance major.
I'm Kearstin Hilligoss. I'm from Sand Springs, Oklahoma, and I'm studying finance and economics.
Hi, my name is Daniel Owens. I'm from Kansas City, and I'm a current MBA candidate after graduating in 2019 with my degree in finance.
My name is Kristen Jacobs. I'm from St. Louis, and I'm a finance and marketing major.
My name is Muriel Unseth. I'm from Peoria, Illinois, and I'm a master's student in the English department after graduating in 2019 with degrees in English and accounting.
While the events of 2020 have had diverse international effects within the U.S. economy, the coronavirus pandemic has accelerated the shift towards an increasingly digital world. From a consumer standpoint, this is manifested through an increased percentage of sales directed through e-commerce channels. From a business standpoint, the coronavirus has highlighted the importance of digitization and technological dexterity.
Cloud computing, virtual communication tools, digital banking, and various other aspects of digitization have significantly increased in demand thanks to the national lockdown and the growing number of people working from home. We believe that this disruptive shift towards digitization offers a timely opportunity for investment.
The CDC estimates that a vaccine will not be readily available to the general public until mid to late 2021. We estimate that even with a vaccine, the shift towards digitization will persist. We utilize mean variance optimization to help formulate our sector weightings. Understanding the historical performance of a sector is important, and 2020 has highlighted the fact that past returns are not indicative of future performance.
Because present volatility decreases the predicted value of past performance, we based our analysis on sector-specific qualitative and quantitative information to determine our sector weights in conjunction with the results of the mean variance optimization, rather than solely utilizing an analysis of historical returns.
Our recommendations are based on a positive economic outlook of future market recovery fueled by the durability of core subsectors and projected growth opportunities centered around technology and e-commerce. We have selected our ratings with an eye towards stability, independent of the uncertainty surrounding the availability and efficacy of a vaccine.
The communication services sector contains companies engaged primarily with marketing, online communications, telecommunications, and broadcasting. There are a few companies that dominate the industry in terms of market capitalization, like Google, Facebook, Netflix, Disney, as well as the three largest telecom providers, Verizon, AT&T, and T-Mobile. This relatively new sector replaced the telecommunications sector and reallocated securities from the consumer discretionary sector to the new communication services sector. We recommend overweighting the communication services industry due to heightened demand and bolstered profitability that has highlighted the necessity of virtual communication systems. The industry is in the midst of a reallocation period as companies look to shift away from traditional print media and focus instead on digital marketing and digital communications. The sector is well diversified, with demand stemming from all industries. Growth in specific markets, like cloud computing, have virtually unlimited growth potential that could be shared by numerous firms. Growth in the communication services industry as a whole is inevitable given the increased digitization of businesses and our everyday lives. Regardless of when the world returns to normal, our reliance and need to communicate will not go away. Growth in the industry will largely be driven by an increased demand for cloud computing, e-commerce, and broadband demand. You can see in the predictions for future revenue growth for Amazon Cloud Services, the addressable market is predicted to more than double in 5 years, with Amazon only having the capacity to meet 30 to 40% of the demand. The need for broadband access has been highlighted as millions of employees shift to remote work. While cable and satellite companies have enjoyed increased demand for broadband access, reduced programming, specifically sports broadcasting, has hurt overall revenues in the broadcasting sector. Sports programming accounted for the largest percent of revenues for broadcasting, and with major delays in tournaments and reduced seasons, broadcasting networks have seen less revenues from ads. However, public support for increased broadband infrastructure, particularly in rural areas and lower-income communities, has increased, and initiatives to expand broadband access is supported by both major U.S. political parties. There are some risks in the communication services sector, like antitrust lawsuits, high valuations, and the possibility of increased regulations. We see these as long-term risks and likely will not affect the industry during our investment horizon of 1 to 2 years. Antitrust lawsuits are very difficult to prove, and companies like Facebook, Google, and Amazon are popular and widely used, making it harder for legislators to gain the support they need. However, the monopolistic power that these companies possess stifles competition and limits innovation. Additionally, valuations for some major communication services have not reached pre-pandemic levels, suggesting that additional revenues generated by increased demand have justified these prices. The PEG ratio of the industry, which factors in growth expectations, shows that companies are still undervalued relative to their pre-pandemic valuations. This suggests that their current prices are justified given the growth projections for these companies. Overall, the communication services industry is poised to capitalize on the market's shift towards digitization. Activities in cloud computing, digital communications, and broadband provide a plethora of opportunities for growth within the industry that will likely persist regardless of the timeliness or effectiveness of a vaccine.
The consumer discretionary sector is diverse, containing companies that provide fashion articles, automobiles and automotive parts, home and office products, luxury fashion and lifestyle goods from companies such as Prada, Burberry, and Hermes, which straddle multiple markets including home decor, leather goods, and perfumes, and more generalized retail including stores like Walmart, Best Buy, Home Depot, and IKEA, specialty apparel brands like Nike, Gap, and Ralph Lauren, as well as travel and leisure goods like restaurants, gambling infrastructure, and hotels. The consumer discretionary sector saw a dramatic decline in revenues during the first half of 2020 due to COVID-19 supply chain disruptions and decreased consumer spending, while certain sub-industries like luxury goods and travel and leisure sustained large losses that are likely to continue in the current lingering state of reduced social activity. Areas such as e-commerce, do-it-yourself automotive parts, and home and office goods have seen relative prosperity. E-commerce in particular has seen substantial and sustainable growth as consumer behavior disruption has accelerated the development of online offerings from traditional brick-and-mortar stores and restaurants. While foot traffic to apparel stores was down 71% in August, online retailers of specialty apparel, particularly athleisure brands like Lululemon and Adidas, have seen triple-digit growth, and other notable digital leaders that bolster our confidence in the sector's recovery include consumer giants like Amazon, Wayfair, eBay, Costco, Target, Walmart, Kroger, Nike, Home Depot, and Best Buy. A PEG ratio analysis of these digital leaders reveals projected stability and growth for these companies with existing or expanded digital sales offerings. Other heavily weighted factors in our decision to overweight the consumer discretionary sector include a confidence in U.S. homebuilder stocks, which were trading at 1.9 times book value as of early October. Additionally, while the automotive subsector saw a distinct decline in automotive sales in March, this was partially offset by sales of automotive parts, and automobile sales are making a quick recovery to pre-pandemic levels. The light truck market in particular, a long-standing cash cow in the industry, is expected to see the revenue benefits of pent-up demand. While the outlook continues to be dampened for consumer discretionary goods in aggregate, the aforementioned subsectors, which represent a significant portion of the sector's revenue, will likely to continue to grow as consumers shift their buying habits to accommodate a long-term shift in social behavior. Despite the continued threat of suppressed travel and decreased in-person consumer activity, we think the opportunities for e-commerce development and expanded online offerings for traditional retailers present a ripe opportunity for revenue growth as the industry adjusts to shifts in demand to accommodate unusual circumstances. Strong year-to-date earnings and revenue compensation between subsectors, as well as consistent consumer activity and an increasing interest in e-commerce, support our recommendation to overweight this industry.
The consumer staples sector is comprised of companies offering essential products such as household items, beverages, food, and tobacco. Consumer staples are goods in which people are unwilling or unable to cut out of their lives. This sector includes companies such as Walmart, Procter & Gamble, Coca-Cola, and many other well-known household brands. The consumer staples sector offers steady growth, dividends, and low volatility. Regardless of the economy, the demand remains constant. Products such as alcohol, tobacco, and food sometimes even increase in demand during economic downturn. There are no substitutes for consumer staples. This sector historically outperformed all but one sector, and has outperformed the S&P 500 during the last 3 recessionary periods. The current trends that drive growth within this sector are online bulk and discount retailers. Consumers are stretching their money as far as possible. Consumers trust in brands they know and are purchasing in bulk. The pantry stuffing trend has been apparent throughout the pandemic. This trend will continue to occur until the vaccine is widespread and the public has no fear of lockdowns. Consumers' staples offer constant profit growth and low volatility. These products are necessities for customers, so they are less likely to cut from their household budgets. There is certainty that consumers will continue to purchase these staples for decades, even in times of recession. With these factors in mind, a market weight for this sector is optimal for our portfolio.
The energy sector is made up of companies that participate in the exploration, production, and distribution of oil, gas, coal, and renewable energy, including biofuels, solar, and wind energy. These companies produce and distribute energy that is needed to power the economy. The main portion of the energy sector can be best described through the oil and gas value chain. Upstream companies deal with the exploration and production, selling their reserves to midstream companies which deal with transportation, processing, storage, and distribution. The product is then sent to downstream companies that refine it into usable products and participate in wholesale and marketing activities. We recommend underweighting the energy sector due to uncertainty caused by the coronavirus and challenges facing the industry. The energy sector has struggled over the last 5 years in terms of its annualized returns and is facing tremendous hardship this year. The impact of stay-at-home orders and less travel have caused OPEC to predict a loss of nearly 10% of oil demand for 2020, and the EIA forecasts a 4% drop in global natural gas demand. Growth in this industry will be largely dependent upon the demand for oil and natural gas as we emerge from the pandemic. According to the EIA, the continued effects of the pandemic in the US, Europe, and Latin America have resulted in lower refinery runs and are especially affecting US petroleum exports. In April, there were substantial declines in U.S. domestic demand for jet fuel and motor gasoline, which resulted in a large reduction to U.S. refinery operations. Since May, demand for some products, particularly gasoline, has increased somewhat but remains below historical levels. Further, OPEC projects that travel and tourism are not expected to achieve pre-COVID levels of activity before the end of 2021. Producers from around the world have been radically rethinking their production plans, and many have already gone bankrupt. According to the September 2020 short-term energy outlook, EIA expects consumption of natural gas by U.S. industries to decline by 4.4% in 2020 and then grow 1.1% in 2021. In terms of renewables, the revenues for wind energy equipment have seen healthy growth over the last 2 years, but its demand is expected to fall over the next 2 years due to an easing of tax credit rules. Companies that focus on wind energy can benefit from federal subsidies for R&D, as well as standards which require a certain amount of electricity to be generated by renewable sources. Considering all these factors, as well as a PEG ratio analysis, we recommend that a small portion of the underweight allocation be invested in the renewables industry, particularly in wind. The PEG ratio of the renewables subsector indicates that it is undervalued and that it is trading at a discount compared to its value.
The financial sector is dominated by commercial and investment banks, insurance companies, and financial service corporations. Some of the major players include Berkshire Hathaway, JP Morgan, Bank of America, BlackRock, and Wells Fargo. The main suppliers of the industry are the Federal Reserve, consumer deposits, and investments. Regulatory pressures, fee depression, low interest rates, and low growth potential add to our underweight recommendation for the financial sector. Economic shutdowns have stalled M&A activity as companies look to conserve cash and focus on liquidity. Diversification and consolidation are expected to spur future demand for M&A. However, the extent of this growth is unknown and relies heavily on government stimulus packages and continued lockdown restrictions due to the coronavirus. The downside risk for the financial sector outweighs the possibility of a quick economic recovery, which would increase loan volume. Our outlook for insurers is negative, with 10-year Treasury yields well below 1%, credit costs rising, and pandemic-related hardships for businesses increasing. Increased mortality rates have decreased operating profits by 10 to 15%. Returns should recover in 2021, but will then likely settle back to 2018 to 2019 levels. Insurance companies exposed to liabilities like long-term care and those positioned to capitalize on the growing U.S. retirement market may be better positioned for growth in the near future. Due to the negative outlook for insurance companies and banks, as well as the minimal effect that fintech companies have on the industry as a whole, we recommend an underweight recommendation for the financial services sector.
The healthcare sector's largest subsectors by revenue include large pharmaceuticals, biotechnology, medical equipment and supplies, and healthcare facilities. Other subsectors include healthcare supplies, managed care, medical equipment and devices, and disease groups. Noted activity includes capital-intensive R&D endeavors with current themes including cancer research in the fields of immuno-oncology, gene therapy and cell therapy, and of course vaccine research related to the COVID-19 pandemic. The 2020 pandemic has disrupted all aspects of the healthcare industry as buying patterns, routine medical visits, non-emergency testing and surgeries, and supply chain infrastructure were stalled and/or subject to unpredictable pressures. While more stable sub-industries, like large pharmaceutical companies and drug distributors, are set to recover, the general unpredictability of the next stages of the COVID-19 situation makes it difficult to predict future demand. An analysis of the biotech and hospital industries, both significant subsectors, has contributed to our recommendation to underweight this sector. Analysts have stressed the importance of hospital restructuring, as only the most aggressive for-profit hospitals were slated to survive even prior to the COVID-19 crisis. Shown here is a graph revealing the thin margins of hospital profitability prior to the spring of 2020. Additionally, consensus sales in biotech have been consistently underperforming or only marginally close to projected estimates. Despite industry strengths like consistent demand in an aging population and active R&D activity to develop specialized treatments, industry weaknesses such as intense for-profit pressures and high regulatory requirements, combined with the political uncertainty of a long recovery period amidst possible pandemic resurgence, carry the day in our analysis. Based on poor returns compared to the S&P 500, unstable or poor projected revenue growth, and the pressure on hospital systems and R&D complications in an atmosphere of looming uncertainty, we have underweighted the healthcare sector in our portfolio.
The industrial sector is composed of an extremely broad set of businesses, but the major revenue drivers within the sector include aerospace and defense, machinery, and business services. The aerospace and defense sector consists of government contractors and aerospace companies that mainly cater to government defense strategies by delivering larger capital products, such as airframers, engines and parts, barrier infrastructure, as well as services supporting those products. The machinery sector also deals with larger capital products and services, providing manufacturing and mining equipment, turbines, engines and locomotives, and serve a wide audience that can consist of anything from data centers, farming operations, construction sites, healthcare facilities, power plants, and more. The business services sector is a diverse group of operations consisting of building distribution companies, which deal with electric, plumbing, and heating supplies, facilities and textiles, which include cleaning services and clothing, and finally staffing, security, and catering companies. Other subsectors that describe the operations within the overall sector include construction, electrical, passenger transport, transportation and logistics, as well as transportation equipment. Revenue growth within the sector, as determined by major sub-industries, is predicted to reach double digits by the end of 2021, but fall back to single digits in 2022. We find today's current political climate and/or transition to be a big threat towards possible revenue growth within the industry due to possible reduced defense spending, as well as political gridlock prohibiting further fiscal stimulus packages from being passed. These numbers are also pretty dependent on COVID not resurging throughout the country, which is currently not the case, as well as the vaccine being widely available by the first half of 2021. Because of this, we recommend underweighting the industrial sector. Our quantitative research shows a lack of returns within the sector, as well as significant losses major companies took due to extreme declines in demand during the pandemic. Many analysts predict a rough and long recovery for most of the companies within this sector. More qualitative reasons for underweighting the sector include the fact that many of the products offered by companies within the industrial sector are large capital investments with longer product life cycles. So customers of companies within the industrial sector will be holding onto their cash more tightly, not replacing any of those items, and will also avoid servicing them as much as possible. There's also going to be less travel and large events than there were before, even as CDC restrictions loosen up within the next 1 to 2 years.
The information technology sector deals with companies that research, develop, and distribute goods and services that are technologically based. Companies within this sector design and manufacture electronics, create software, and provide IT services to customers. This sector ranges from consumer goods like televisions and mobile devices to logistical systems and enterprise software that is sold to companies. In this sector, there are serious concerns about online retailers collecting and sharing people's data, false information being spread over social media, and biases in algorithms. Because of this, there is a threat for new regulations. But ultimately, the strength and opportunities of the sector are what led us to our overweight recommendation. The sector has enjoyed an annualized return of over 20% over the last 5 years. The sector's strong performance during COVID-19 can be attributed to application software, as there has been a large demand for digital commerce and productivity applications as enterprises spend more to go digital. Software is the main industry that is driving the growth of this sector. Cloud application demand is projected to climb sharply post-virus as companies accelerate to a digital format. COVID-19 is thought to have catalyzed the adaptation of companies to cloud infrastructure software. Cloud-based commerce software products like Shopify and Salesforce should see strong demand from new user growth in the next 12 months as more offline retail stores go digital. Additionally, customer service and sales productivity should be the next big category to see growth as companies upgrade to cloud-based applications. Front office applications like these are critical for increasing sales and retaining clients. The performance of infrastructure software companies has well exceeded that of the S&P 500 index through June 2020, rising 27% versus the benchmark's 4% decline. Further, most of the leading application software companies have little to no debt on their balance sheet. For most of them, the percentage of predictable sales exceeds 75% of the total revenue, providing good visibility. The industry enjoys one of the highest margins among all S&P 500 sectors, helping to generate steady free cash flow. Finally, revenue is expected to grow an average of 27% annually for cloud providers. The rollout of 5G networks and a recovery in hyperscale cloud spending should serve as a catalyst to growth for the remainder of 2020 and 2021. Overall, software and tech services should see the strongest growth within the IT sector. The P/G ratio for both industries may suggest that they are overvalued, but this is not surprising as technology stocks typically have a high price-to-earnings ratio. Solid fundamental analysis should be performed before individual securities are selected.
The materials sector is another fairly broad set of operations, some consisting of harvesting raw materials and others include manufacturing those raw materials. The largest subsectors include chemicals, metals and mining, as well as iron and steel. Other subsectors that don't bring in as much revenue but have significant opportunity are construction materials and containers and packaging. The annualized returns for the materials sector were not too bad and haven't seen much growth or decline. Although the sector is currently performing below the market, both our qualitative and quantitative analysis gave us confidence that this sector will be able to provide both stability and opportunity within the next 1 to 2 years. Revenue growth for the materials sector overall is projected to steadily increase over the next couple of years. Although the main revenue drivers took a bit of a hit during the pandemic, we've identified other important factors offering stability and opportunity within the sector. The chemicals industry continues to be supported by agricultural production despite a decline in revenue in other areas. While certain materials within the metals and mining experienced decent losses to demand during the pandemic, such as coal and precious metals, due to new technological hardware advancements, there are exciting opportunities for areas such as cobalt mining, which helps with the production of lithium batteries. The iron and steel industry has held some stability due to fiscal stimulus construction projects, but also faces opportunity in the future due to increased expected demand for improving and creating new infrastructure, whether that be related to city layout improvements, 5G towers, broadband access, or sustainable energy. We ended up with the decision to slightly overweight the materials sector due to its evident stability and increased opportunity over the next 2 years. Analysis that supported this decision includes the stable annualized returns the sector reported the past 5 years, the steady increase in projected revenue growth, as well as the result of our mean variance optimization test, which matched our recommendation to overweight the sector. Along with that, certain sub-industries, such as construction materials and packaging, experienced increased demand as a side effect of the pandemic, which will most likely continue to benefit them within the next year or two. Significant opportunity within mining from technological hardware improvements, as well as within construction materials due to planned infrastructural improvements, also helped solidify our decision.
The real estate sector comprises real estate investment trusts. REITs are companies that own, operate, or finance income-generating real estate. REITs are similar to mutual funds and use the funds of numerous investors. REITs invest in the majority of real estate property types, such as apartments, hotels, warehouses, malls, medical facilities, and offices. REITs are attractive to investors since the investor is not purchasing physical assets. It offers an attractive alternative to buying real estate property. Real estate has been the worst performing sector in the S&P 500 during the coronavirus pandemic due to the disproportionate effects of the economic shutdowns on commercial real estate. REITs have underperformed the S&P 500 over the past 10 years. Residential REITs are showing strength in comparison to other property types. However, this strength could fade if the economy does not rebound. Retail REITs are suffering due to consumers transitioning from physical stores to online shopping. The performance of REITs has varied by sector, and recovery will depend on the state of the coronavirus and the economy. The outlook for REITs in 2020 remains favorable. Real estate markets have low vacancy rates and a balance of new supply and growing demand, supporting rent growth and REIT earnings in the year ahead. However, rising vacancies or slowing rent growth could hinder growth within the sector. Revenues for the industry are expected to decline in 2020 due to the pandemic-induced slowdowns in commercial real estate. Industry operations are expected to remain resilient in 2020 as REITs work to mitigate the effects of reduced commercial real estate activities. The REIT sector offers stable cash flows and steady returns. There is continuous demand and growth potential within the sector. With these factors in mind, a market weight in this sector is optimal for our portfolio.
The utilities sector is much smaller, consisting of electric utilities, gas utilities, and utilities networks. The returns for utilities have declined quite a bit in the past 5 years and are currently performing beneath the market. Historical returns have remained pretty volatile over the past 4 to 5 years, making it hard to predict when and if the sector will be able to perform or even outperform the market. Understanding revenue response to change in demand within the utility sector is essential for projecting the sector's future performance. One of the regulations existing within the industry is decoupling policies, which disassociate a utility company's revenue with sales volume of a particular utility. These were originally created to help encourage efficient energy usage so utility companies could be fairly compensated through an adjustable rate regardless of how much energy is used or sold. While these decoupling policies help provide stability to utility companies during tough economic periods such as this one, those policies don't exist in every state. This is a problem especially for utility companies serving more commercial than residential buildings, as many companies have extended work-from-home orders indefinitely. While we expect the economy to steadily improve over the next 2 years, we aren't expecting companies to return to their normal in-person work habits for quite a while, if they ever decide to have everyone work from the office again. Regulation to check the monopolies also blocks any major avenues for growth elsewhere, making the sector an unsustainable investment. We recommend underweighting the utility sector for several reasons. Annualized returns have continually decreased the past 5 years, and revenue growth is estimated to increase in 2021, only to drop again in 2022. While demand may pick up a bit as people are allowed to return to work in person, we're predicting that utility usage within commercial buildings won't return to what it was before the pandemic, significantly impacting companies within deregulated states. We don't trust that the sector will return to its original stability with a new normal being adapted under COVID guidelines.
In conclusion, we believe that the disruptive but sustained shift towards digitization caused by the coronavirus offers a timely opportunity for investment. We look forward to answering your questions.